Well, everybody expects the Fed to lower rates, so that's really in stock prices that are
Is
moving
it already
higher.
priced in?
We think a lot of that is. It will give a positive bias. In terms of the earnings season, which is critically important, it's coming in pretty good. About 75% of companies are beating expectations, which is in line with the past few quarters.
On the top or bottom line?
In terms of the bottom line. In the top line, the beat rate's been about 55 to 60, which also is in line with the past few quarters. The outlooks have been a little bit more cautious. Interestingly, few, if any, companies are talking about interest rates being too high. So while the Fed's lowering rates, that's really not going to help business. What companies are warning about is trade with China, and that's slowing the global economy and causing them a little bit more pause when they look at the future.
How much that bottom line cut, though, is because of the massive buybacks? You know, companies just keep buying back their own stock, reducing the amount of available equity, which makes earnings per share look better.
A portion of it definitely is by financial engineering, but if a company can buy back stock at 12 or 14 times earnings, it is accretive for the long-term value of the business. So we're very much in favor of things like that. But companies are also running themselves pretty well. They're operating, they're controlling costs, so they're hitting the bottom line and they're growing earnings, and that's a very good thing. Now, you're talking about an environment where bonds are 2%, so stocks at 16.5 or 17 times earnings are pretty attractive.
Help us make some money and talk about stocks that you find attractive. AbbVie, it's had a tough year, but it's got a nice yield of more than 6%.
Right. So the things that we're recommending today are stocks that have good long-term outlooks but have really lagged or done poorly this year. AbbVie's at the top of that list. It's down about 15%. The yield's over 6.5%. It sells under 10 times earnings. We think they have good long-term prospects, and you're getting it at a great price. The average pharmaceutical is at about 14 or 15 times earnings, so you're getting this at about a third off.
Wells Fargo, one of the biggest banks of the world, scandal after scandal, trouble finding a permanent CEO, but that's not keeping you away from the stock. How come?
Well, it's been an absolute dog. It's been in the penalty box, and as a result, it sells at a very attractive valuation. It's one of the cheaper banks right now, but the footprint is among the best in the group. They have a great loan quality portfolio, very good capital ratios. They're allowed to buy a lot of stock back. They've been allowed to raise the dividend very significantly. We think that they're well on the way to fixing themselves, and that's not in the stock price. So we like the financial group in aggregate. We think Wells Fargo is very well positioned.
Also, in the space that I cover, which is oil and gas, I mean, listen, these energy stocks have been just crushed. If you go down to some of the small and mid-cap names, they're down 60, 70% in 12 months. The bigger cap names, a CEO we've talked to many times, Ben Van Beurden, Royal Dutch Shell, they continue to perform, and you also like that name.
Well, the business is doing well. The stocks have not done well.
No,
Royal Dutch has done miserably.
Terrible. Can't get out of their own way.
Right. So the small stocks have done worse, but Royal Dutch also hasn't done well. But oil prices are up sharply. The company's cash flows are better. They're going to be returning more capital to shareholders, yet you're getting about a 6% yield and under 11 times earnings. So we think at some point, oil companies' stocks catch up to the better oil prices.